Look at this title. It sounds like a boring corporate report, right? Wrong. What you're looking at is the autopsy of the global energy market. While most investors are chasing, quote, green growth, we found a hole in the industry's pocket the size of a crater. Today, we're not talking about who has the most oil. We're talking about who can actually get it out without starting World War III. Welcome to the energy paradox of 2026. It's not about how much you have. It's about where you're standing when the music stops. To understand the madness, you have to look at this tiny strip of water, the Strait of Hormuz. Think of it as the carotid artery of the world. Every single day, 21 million barrels of oil and gas pulse through here. That's enough to fill about 1,300 Olympic-sized swimming pools every single day. If this artery gets squeezed, the global economy doesn't just get a headache, it goes into full cardiac arrest. And in 2026, the blood pressure in this region is reaching critical levels. Now let's talk about your wallet. If someone blocks that 21-mile gate, we aren't just looking at expensive gas. We're looking at a structural shock. Imagine waking up and finding out oil isn't $75 anymore, it's $150. That's not a price hike, that's a margin killer. For companies like Saudi Aramco, it means they're sitting on a mountain of gold that they literally cannot ship. It's like having $1 billion in a bank account that just got frozen. The spare capacity everyone talks about? It's useless if the front door is locked. Here is the wow moment. In 2026, the quality of your oil doesn't matter. What matters is your GPS coordinates. We've ranked the giants, and the results are shocking. Chevron is winning not because they're smarter, but because they're geographically lucky, zero Middle East exposure. Meanwhile, Saudi Aramco is the biggest player on Earth, but they're standing in the middle of a lightning storm. In this scenario, being big is a liability. Being far away is the ultimate strategy. Aramco is a beast. Their production cost is $3.51. That's cheaper than a fancy latte in London. They should be printing money. But here's the joke. They have a paper profit trap. They can produce all they want, but their east-west pipeline is like trying to empty a swimming pool with a drinking straw. In 2026, all those AI-optimized wells won't help if the tankers can't leave the dock. They are the definition of all dressed up with nowhere to go. If Aramco is the king in a storm, Chevron is the guy with the luxury bunker in Guyana and the Permian Basin. They've spent billions buying their way out of trouble. 43% of their lunch comes from North America now. When the Middle East catches a cold, Chevron doesn't even sneeze. They are the ultimate safe haven play for 2026. They aren't just selling oil, they're selling peace of mind to investors. BP is playing a different game. They're like that friend who doesn't own a car but always manages to get a ride. Their secret sauce isn't just oil, it's their trading desk. They can move LNG around the world like a chess grandmaster. They've been cleaning up their house, selling off the junk, and focusing on cash. Don't let their messy statutory profits fool you. Their actual cash under the mattress is incredibly strong. Phillips 66 is the world's biggest middleman. They don't dig for oil, they buy it, cook it, and sell it. Usually, that's a great business. But in 2026, when the raw ingredients get crazy expensive, the middleman gets squeezed. Their secret weapon? NGLs, natural gas liquids. It's the side dish that's actually making more money than the main course right now. But make no mistake, they are walking a tightrope with these global supply chains. Now, let's look at the tragedy of the bunch, IRPC. Their profit margin is minus 0.92%. Yes, they are literally paying people to take their products. They are stuck between a rock, high oil prices, and a hard place, China flooding the market with cheap stuff. They are surviving on parental support, low-interest loans from PTT. If a shock hits in 2026, IRPC doesn't just break, it shatters. This is the canary in the coal mine for the Asian energy sector. Time for a reality check. Corporate accounting is like a dating profile. Everyone highlights the good stuff and hides the baggage. Look at BP. Their profit looked like a disaster, but their actual cash flow was 445 times their reported profit. Why? Because they took a big bath, writing off old junk to make the future look brighter. When you see a company reporting a massive loss in 2026, ask yourself, is the house burning down, or are they just throwing out the old furniture? Here is the cold, hard truth. The more money these companies make, the more governments want to steal. I mean tax. In 2026, profitability triggers the sovereign clawback. The UK is taking 78%. California is capping margins. It's like winning the lottery, only to find out the government takes 80 cents of every dollar. For the energy giants, success is becoming a political liability. You can't just be profitable, you have to be, quote, politically invisible. So what's the bottom line? In 2026, safety is the new scarcity. A barrel of oil in West Texas is worth more than 2 barrels stuck in the Persian Gulf. The winners aren't the ones with the most resources, they're the ones with the shortest, safest paths to the customer. The bifurcation is real, and if you're on the wrong side of the choke point, you're just holding a very expensive piece of paper. This was just the tip of the iceberg. At HDIN Research, we don't just read the news, we audit the future. If you want the full-page fiscal audit of these giants, or if you need a geopolitical risk map that actually makes sense, reach out. The email is on the screen. Don't play the 2026 market with 2020 logic. Stay sharp, stay diversified, and we'll see you in the next deep dive.